What is leverage ratio? Leverage ratio measures the proportion of business capital financed by debt, indicating a company's reliance on borrowed funds over equity. It assesses investment risk and a company's ability to meet financial commitments. The ratio varies across industries, with airlines, banking, and capital goods businesses typically having higher leverage, while startups also tend to carry substantial debt. Leverage involves using borrowed funds to finance assets, increasing potential returns while amplifying risks. It consists of operating and financial leverage. Operating leverage depends on a company's cost structure, where higher fixed costs lead to greater operating leverage. Financial leverage is influenced by capital structure, with higher debt levels indicating greater financial risk. Managing leverage effectively is crucial for financial stability, as it can enhance gains but also magnify losses. Businesses borrow funds for expansion or operations when they lack sufficient capital or seek higher returns through leverage. However, if investments fail, companies face losses along with interest obligations. Borrowing is beneficial only if returns exceed debt costs. Creditors analyze leverage ratios to assess financial health and default risks. A very high ratio signals excessive debt, increasing bankruptcy risks, while a very low ratio suggests conservative management that could limit growth.
Right now, Calkine is offering a 7-day free trial on its premium research reports. Get access to data-driven market insights combined with an in-depth analysis on financial markets across the globe. Don't miss it. Subscribe for the free trial now.
Several types of leverage ratios offer insights into financial stability. The debt-to-equity ratio measures total obligations relative to shareholder equity, showing a company's reliance on debt. The debt-to-capital ratio compares total obligations to total capital, indicating financial risk. The debt-to-EBITDA ratio evaluates a company's ability to repay debts using operational earnings. The debt-to-assets ratio reveals the proportion of assets financed by liabilities, with a ratio above 0.5 indicating a heavy reliance on borrowings. Coverage ratios assess debt management capacity. The interest coverage ratio measures how well a company covers interest payments through operating profit. The debt service coverage ratio evaluates whether a company can meet total debt obligations. The fixed charge coverage ratio determines the ability to cover lease and debt expenses. The asset coverage ratio assesses a company's capacity to repay debts by selling assets. Leverage ratios are vital for businesses, investors, and creditors to evaluate financial stability, risk exposure, and investment potential. Properly managing leverage ensures sustainable growth and minimizes financial vulnerability. For more related videos, please subscribe to the channel and click the bell icon to get notifications.